Welcome to the Deep Dive. We're here to cut through the noise, look past the political spin on complex policies, and really just pull out the solid knowledge you need.
Yeah, get you properly informed.
Exactly. And today, we're diving into a really thorny issue in UK politics, the government's whole economic agenda, specifically around jobs.
Oh, absolutely. It's a hot topic. You hear all sorts, don't you? Critics saying, there's no real plan, it's just slogans.
Right.
And then on the other side, you've got these massive job creation targets being thrown around by the government.
That sums it up perfectly, that tension. So our mission today isn't about picking sides, not at all. We're going deep into a rigorous expert policy audit.
Mm-hmm.
This audit covers that crucial period from mid-2024 right through to Q3 2025. And we're trying to objectively measure the gap. Is there, a huge difference between what the government says its policy will achieve and what's actually happening on the ground in the labor market?
Finding that operational truth.
That's it. Okay, let's unpack this assessment for you. What's the very first takeaway?
Well, the first thing that jumps out when you look at the actual strategic documents, it pretty much debunks that whole no plan idea straight away.
Really?
Yeah, definitively unfounded, according to this analysis. The government has laid out a very clear, actually quite detailed, multifaceted strategy. It's a long-term supply-side approach.
So not just cobbled together.
Not at all. It's anchored in some big ideas. The Green Prosperity Plan, setting up this National Wealth Fund, or NWF, and making these big structural reforms, tackling things like health and skills, the strategic vision, the overall picture. It's undeniably coherent, comprehensive even.
Okay, coherent vision. So why all the political flack? Why are those attack lines, no plan? Why are they sticking? Where's the disconnect?
Ah, the disconnect. Well, that comes down to implementation, and crucially, the short-term results.
Right.
While the long-term plan might be solid, this audit immediately flags a pretty significant gap between that ambition and what actually happened in the first, say, 12 to 18 months. Yeah, a big policy lag. Basically, the good stuff, the benefits from these reforms, they just haven't kicked in fast enough to counter the wider economic problems, the headwinds.
Okay, policy lag. Is there one specific piece of data, one number, that really illustrates this gap for our listeners, the gap between the plan and the reality?
Yes, there is, and it's the unemployment rate. By the third quarter of 2025, unemployment had climbed, quite sharply actually, to 5.0%.
5%?
5%. And just for context, that's the highest rate the UK had seen since early 2021, back when we were still grappling with the pandemic recovery.
Wow.
And that's not all. It's compounded by a measurable fall in the net number of payrolled employees.
So fewer people on the payrolls overall.
Exactly. So you've got this grand strategy designed to create hundreds of thousands of jobs.
Right.
But the immediate result in that first year or so is actually more people out of work.
That is a stark finding. It sounds like, they've drawn this beautiful, intricate map for a long journey. But in the first year, the cars actually rolled back down the hill a bit.
That's a good way to put it.
So what's the audit's core verdict on why this happened? Why this failure to launch?
Well, the core verdict points heavily towards the cyclical cooling of the economy. The short-term effects of things like higher interest rates, a global slowdown maybe. Those factors have, so far, just completely swamped any immediate positive effects from the government's long-term industrial policies.
Swamped them.
Yeah. The analysis calls this failure to get ahead of the curve a major implementation deficit and a substantial policy lag.
And this lag isn't just, inconvenient.
Oh, no, it's much more serious than that. It poses a real sort of existential threat to the whole plan's long-term effectiveness and public confidence, too, of course.
Right.
It's basically a race against time. And right now, the short-term pain is definitely winning.
Okay, I want to push back slightly. Is it only about these wider economic headwinds? If the plan itself is sound, shouldn't we be seeing some little signs of job creation, some green shoots, perhaps?
That's a fair question.
Let's move into part one then and look closer at that map they drew, the strategic architecture. What's the actual foundation they're building this growth on? What are they betting the house on?
Okay, the foundation is what they call the Modern Industrial Strategy, the MIS, and it's explicitly structural.
Structural meaning.
Meaning it's not just about trying to boost consumer spending in the short term. It's focused on deeper reforms, long-term investment in capital, and really getting to grips with these long-standing weaknesses in the labor market. Things like skills gaps, training, public health issues.
That sounds like a pretty big shift from how things used to be done in the UK, doesn't it? more hands-off, traditionally.
It's a huge shift, yeah, a move away from that more laissez-faire approach towards certain sectors.
And the main engine for all this, the absolute centerpiece of the MIS, is this ambition to make the UK a clean energy superpower. That's the phrase they use.
That's the big one.
It sounds great politically, but what's the actual economic payoff they're expecting? According to the official documents, what's the job number attached to that?
The target is massive. The projection is that hitting this goal, which covers everything from wind farms to carbon capture, green hydrogen, the lot will generate really substantial employment gains.
How substantial?
The related papers point towards projections of up to 725,000 jobs by 2030.
725,000. Wow.
Yeah, so we're not talking about a minor tweak here. This
Right.
signals a fundamental, decade-long push to really pivot the UK's entire industrial base. It means the government is actively picking winners, essentially,
Yep.
deciding which sectors are the future and channeling resources towards them.
Picking winners. Directing huge amounts of capital investment.
Yeah.
That sounds very different from the free market thinking that often dominated UK policy for decades. This is proper strategic state intervention, isn't it?
Absolutely. It's strategic state intervention. And the sources actually label this approach catalytic state capitalism.
And catalytic state capitalism. Okay.
You have to see it in a global context, right? The UK isn't doing this in isolation. If you look at sectors like clean steel or battery production gigafactories or green hydrogen,
Yeah.
governments everywhere, from the US with its Inflation Reduction Act to the EU and its Green Deal, they're all using massive public funds, subsidies, incentives to attract investment in these areas. The UK, frankly, can't just sit back and hope the private sector magically creates these industries on its own. It would get left behind.
Okay. Explain that catalyst role a bit more. Why can't big private companies just fund these massive projects themselves without the government stepping in?
Well, it comes down to risk and scale. Think about building a huge new clean steel plant or setting up an entire supply chain for batteries. These are incredibly capital-intensive sectors.
Huge upfront costs.
Exactly. Massive scale, enormous upfront investment, and often a really long time before you see any return, maybe 5, 10 years, sometimes more.
And private money doesn't like that kind of long-term risk.
Generally, no, especially not in new or, relatively unproven technologies. Private capital tends to be quite risk averse. So the government, through this catalytic approach, steps in. It uses public money to essentially de-risk those massive initial investments by providing some foundational funding, maybe infrastructure guarantees, the kind of certainty that private investors need before they'll commit their own, much larger sums of money.
So the government is basically saying, look, we'll take the initial hit, the politically tricky risk, so that you, the private sector, feel safe enough to come in with the billions needed to actually build this stuff.
That's pretty much it. But, and this is a big but, the audit highlights, this strategy comes with significant political risk baked in.
How so?
It means the government, and by extension the taxpayer, has to accept elevated risk exposure, and that guarantees intense public scrutiny. If, say, the government puts $500 million into a green hydrogen project and it doesn't pan out commercially,
The public will want answers.
absolutely, because it was public money that took the gamble.
Yeah.
So the ultimate success of that huge 725,000 job target, it rests entirely on whether these big primary industrial bets actually pay off.
Which makes the vehicle for delivering this money absolutely critical.
Yeah.
The mechanism itself. So let's move to part 2 then. The National Wealth Fund, the NWF. This is where the government's financial commitment really takes shape, right?
Yes, the NWF is the key tool. It's the engine designed specifically to deliver on that industrial ambition. It's structured as a long-term investment vehicle, and crucially, it's designed to partner up with the private sector.
And the headline figure, the total commitment.
The total commitment is £7.3 billion allocated for investment over the current parliament. And it's important to stress this isn't day-to-day spending money, this is capital investment. Money intended to create long-lasting physical assets, factories, ports, infrastructure.
Okay, 7.3 billion pounds. It's a big number, but it can sound a bit abstract. I think it's really important we break down where that money is actually going. It's not just sprayed around, is it? It's highly targeted.
Intensely targeted, yes. It directly reflects those priorities set out in the modern industrial strategy we just talked about.
So where's the biggest slice going?
The largest single chunk, £2.5 billion, is earmarked for clean steel.
Clean steel. Why so much there?
Well, it's seen as absolutely crucial for decarbonizing a foundational UK industry. It helps protect existing high-value jobs, often in traditional industrial areas, while also making UK steel competitive internationally in a low-carbon future.
Okay, 2.5 billion for steel. What's next biggest?
After steel comes ports with 1.8 billion pound. This reflects the reality that you can't be a clean energy superpower, especially with offshore wind, without the right port infrastructure. You need places to build turbines, deploy them, and handle the goods coming out of new green factories.
Makes sense. Logistics. What about manufacturing itself?
That's next. Gigafactories, battery plants are set to get 1.5 billion. This tackles that critical need for the UK to have its own battery manufacturing capacity, mainly to support the shift to electric vehicles and secure the future of the car industry here.
Okay, steel, ports, batteries. What else is in the mix?
Two other key areas. 1.0 billion is allocated to carbon capture, usage, and storage CCUS. That's seen as essential technology for cleaning up industries that are really hard to decarbonize otherwise, like cement or chemicals.
Right.
And finally, 500 million is directed towards green hydrogen, recognizing its potential as a future clean fuel, particularly for things like heavy trucks or certain industrial processes.
Okay, that breakdown really shows the strategic thinking. These are all massive, capital-heavy sectors. But let's bring it back to the core goal, jobs. Is there a specific job target attached directly to this 7.3 billion pound investment?
Yes, the government connects this spending, along with some related policies like big pushes on home insulation, for example, to a target of creating 656,500 new jobs.
656,500
Yeah.
almost mirrors the overall green target.
Pretty close. But what's really critical for listeners to get here is the type of jobs these are expected to be.
Go on.
They are overwhelmingly skewed towards quite specific technical skills needed for this net zero transition. We're talking about electrical engineers, plumbers who can install heat pumps, HVAC technicians, people skilled in advanced manufacturing, specialized construction trades.
So not general service sector roles. These require real training.
Exactly. Very specific, often vocational competencies.
Okay, now let's get to what you called the crucible of the NWF, the ultimate test. It's not just about how much public money it spends, but how much other money it pulls in alongside it. That 3x leverage multiplier you mentioned.
This is it. This is the absolute fundamental test of whether this whole catalytic state model actually works in practice. The NWF has been given a very strict mandate. It must attract 3 times the amount of private capital for every pound it invests itself.
So for every 1 pound of taxpayer money going in,
It needs to persuade private companies, investors, pension funds, whoever, to put in 3 pounds alongside it. That ability to crowd in private investment, that's the make or break metric. It's the non-negotiable definition of success for the NWF.
why is that multiplier so important? Is it just about making the government's money go further?
Well, yes, partly. But it's more fundamental than that. Without that private sector buy-in, the 7.3 billion pound, while a lot of money, actually runs out pretty quickly when you're talking about building gigafactories or new port infrastructure. It just wouldn't achieve the necessary scale.
Right.
If, however, they do hit that 3x target, then the total amount of capital being mobilized, public plus private, jumps to a massive 29.2 billion.
29.2 billion. Okay, that's a different league.
Exactly. And that level of investment is what you actually need to genuinely transform the industrial base and have a realistic shot at creating those 650,000 or so jobs. If the private sector doesn't buy the government's de-risking strategy, or if they lose faith in the long-term plan,
The multiplier fails.
the multiplier fails, and the government just ends up funding a few, maybe impressive, but ultimately isolated projects that never reach critical mass, they become expensive white elephants. So the pressure on the NWF to prove its commercial chops and prove them quickly is absolutely immense.
It's fascinating. The whole industrial strategy, the NWF, it's all geared towards fixing the demand side of the equation, creating the jobs for people to fill. But the audit seems brutally clear that the UK has this other massive, deep-seated problem on the supply side. The people needed in terms of their health, their availability, their skills, they just aren't there in the numbers required.
That's the perfect transition. Because you're right, the industrial plan is basically meaningless if you don't fix the supply side alongside it. Which brings us to part 3, structural reform, fixing the labor supply, and quality.
And the source material here, honestly, it's quite shocking. It identifies the UK's fundamental labor market problem not as a lack of jobs being offered, but as a health and capacity crisis. I really think we need to spend some time on this. What's the single most alarming statistic that defines this crisis, this problem of economic inactivity?
Okay, the number that should really make everyone sit up and take notice. It relates to the overall rise in economic inactivity among working-age people since 2020. That number went up by about 900,000.
900,000 more people not working or looking for work.
Correct. But here's the kicker. A staggering 85% of that 900,000 increase is attributed to people who describe themselves as long-term sick.
85%.
85%. This isn't primarily about early retirement or students. It's
Wow.
fundamentally a public health crisis that's spilling directly into the economy.
So doing the maths, that's around 765,000 people who've dropped out of the potential workforce, mainly because they're too ill to work.
That's the stock figure, the overall number. But the flow figure, the rate at which people are leaving, is just as devastating. Annually, the UK sees around 300,000 people aged 16 to 64 leave the workforce entirely because of health conditions that limit their ability to work.
300,000 every year.
Every single year. Just think about that number for a second. It's like the entire working age population of a major city like Nottingham or Newcastle just vanishing from the labor pool each year, primarily due to health reasons, many of which might be treatable or manageable. It's a profound structural drain on the UK's productive capacity. Decades in the making, perhaps.
That drain alone, 300,000 people a year.
Yeah.
That's enough to completely undermine any job creation plan, however brilliant it is. It's like trying to fill a bath with the plug out.
Precisely. It's a massive legacy failure that needs deep systemic intervention.
So given this backdrop, what's the government's specific policy response? How are they trying to tackle this labor supply crisis? Is this where the Get Britain Working plan comes in?
Yes, exactly. The Get Britain Working White Paper, which came out around November 2024, is the government's direct acknowledgement that you can't fix the economy without fixing the NHS and related support systems.
Okay.
It was backed by an initial $240 million investment. And the core idea is to implement systemic health reforms that directly link getting people back to work with the NHS's capacity and, importantly, the speed of treatment. It recognizes that long waits for diagnosis or treatment for both physical and mental health issues are directly translating into lost work days and people dropping out altogether.
Right. The connection is explicit. So what specific health measures are they promising to actually speed things up and increase capacity?
The focus is very much on bottlenecks. Some key promises include delivering 8,500 more mental health staff. That's vital because we know there's a huge link between mental health conditions and long-term inactivity.
Okay. More staff. What else?
They're also aiming to secure 40,000 extra elective appointments, things like scans, consultations, minor procedures every single week, trying to clear those backlogs.
40,000 a week.
Yes, and perhaps most critically, there's a systemic commitment, guaranteeing that no patient waits more than 18 weeks from the point they're referred by their GP to actually starting treatment.
The 18-week target. That's been around before, hasn't it?
It has, but
Right.
recommitting to it and actually achieving it consistently would be huge. If they could deliver that, it would arguably be the single most powerful lever they have to reduce that 300,000 annual outflow figure we talked about. Getting people treated faster means they can potentially return to work much sooner.
Okay, so that's the plan to fix the capacity, the health side. But what about actually helping people back into a job once they are well enough? What support initiatives are part of this Get Britain Working plan?
Yeah, it's not just about treatment. The white paper includes targeted support. For instance, they're rolling out a program called Connect to Work. This is a specialist-supported employment service aiming to help up to 100,000 people per year from 2026 onwards. These are individuals who face quite significant barriers to finding or staying in work.
100,000 a year through that scheme.
That's the target. And alongside that, there's also the youth guarantee, specifically for 18 to 21-year-olds. The idea there is to step in early and prevent young people from falling into long-term inactivity right at the start of their careers, offering them tailored training or placement support.
Okay, so we've got the industrial plan, the NWF, creating demand. We've got the supply plan, health reforms, and back-to-work support, trying to boost the number of available workers.
Right.
What's the third pillar of this structural reform agenda? Is it about the quality of the work itself, making jobs better so people stay in them, stay healthy?
That's exactly it. The third piece is the Employment Rights Bill, or ERB.
The BRB.
Yes. And the stated intention behind this is huge. It's billed as delivering the biggest upgrade to workers' rights in a generation.
Strong words. What's the economic thinking behind that?
It's pretty straightforward, really. The argument is that job insecurity, poor conditions, low pay, These things contribute significantly to stress, ill health, and people leaving the workforce. So if you make work fairer, more secure, better paid, people are more likely to stay employed and stay healthy. It tackles that attrition problem from a different angle.
Makes sense. So what are the key cornerstone provisions in this bill that are supposed to achieve this big upgrade in job quality?
Well, some of the headline measures include banning what they call exploitative zero-hour contracts, seen as a major source of income insecurity for many.
Okay, that's a big one.
Definitely. Also, strengthening rights for workers right from day one of their employment. And importantly, putting an end to controversial fire and rehire tactics, where companies could dismiss staff and offer them their old jobs back on worse terms. That really damaged worker confidence.
Right, I remember the controversies around that.
And finally, there's also a commitment within the bill to increase statutory sick pay, or SSP. So, taken together, these measures aim to raise the basic standards of employment, particularly targeting those in lower paid or less secure jobs.
Okay, so the plan is laid out. Bold industrial strategy with the NWF, critical health and back-to-work reforms, and this big upgrade to employment rights. It sounds comprehensive on paper.
It does.
Now, let's move into what might be the most sobering part of this analysis. Part 4. The quantitative assessment. Looking at the cost, the context, the actual numbers on the ground, we need to figure out the price tag for this vision.
Right. This is where we try and put some pounds and pence figures against the government's role as that catalyst. If we look purely at the committed public money, that £7.3 billion from the National Wealth Fund, and we divide it by the number of jobs they're targeting, the 656,500 figure,
Yeah.
we can calculate an implied direct government investment cost per job. And that figure comes out at approximately 11,119 HAP per job.
Just over 11,000 pounds of public money per job created.
Yes.
That's a significant upfront investment, isn't it? Especially for jobs that might not fully appear until closer to 2030.
It is, and you can already hear the critics arguing that's too expensive. But remember, the government's own measure of success isn't just that direct cost. It's about pulling in the private money, that 3x leverage.
Yes, the multiplier. How does that change the calculation? What's the total capital cost per job if they succeed in getting that private investment?
Well, it transforms the picture. If, and it's a big if, the NWF hits that 3x target, the total amount of capital mobilized across these key sectors, public money, plus the private money it leverages, reaches that 29.2 billion PDO figure we mentioned.
All right.
Now, divide that total investment by the same 656,500 targeted jobs, and the total capital expenditure per job, public and private combined, jumps dramatically. It comes out at approximately 44,500 pounds.
44,500 pounds. Total investment per job.
Roughly, yes. And that figure, 44,500 pounds, gives you a much better sense of the kind of ambition here. They're not aiming for low-paid, low-capital jobs. They're aiming for high-value, capital-intensive roles in advanced industries, and those inherently require a massive scale of investment to create.
That context is crucial, but you're saying even that number doesn't tell the whole story.
Not quite, because that 44,500 pounds figure, it really only covers the hard capital costs, building the factories, installing the wind turbines, upgrading the ports. It doesn't factor in all the necessary extra spending on the human capital side. The training?
The skills gap again.
Exactly. The sources highlight this critical legacy problem. Over the previous decade or so, the budget for adult education in England saw a real terms fall of something like 45%.
45% cut. Wow.
Yeah, so to actually find people qualified to do these new 44,500 pounds of pop jobs, the government is also having to spend heavily right now on things like new skills boot camps and other vocational training programs, basically just to play catch up.
So the true cost of creating one of these sustainable, skilled jobs is actually much higher than 44,500 pounds because you have to add in the cost of fixing years of underinvestment in training the workforce.
Precisely. It's like the hidden cost of past neglect. You can't just magic up a new high-tech industry. You often have to build the workforce for it almost from scratch, and that takes serious money and, critically, time.
Time. Okay, now let's tackle probably the most politically charged number that gets thrown around in this whole debate. That claim you sometimes hear that, say, 300,000 jobs have been lost under this government. We need to be really clear for our listeners. Where does that 300,000 figure actually come from, and what does it truly represent?
Yes, this is absolutely crucial because political spin often deliberately muddies the waters here. Let's be crystal clear. The claim that 300,000 jobs were somehow lost because of current government policy failure during this audit period is simply not accurate based on the data.
Okay, so where does 300K come from?
As we discussed back in part 3, that 300,000 figure represents the approximate number of working-age people who leave the labor force every single year primarily due to long-term sickness or work-limiting health conditions.
So it's that annual structural drain we talked about.
Yeah.
It's a symptom of a long-running problem in the health system and the labor market.
Exactly.
It's not a measure of net job losses caused by policy decisions made between mid-2024 and Q3 2025.
Yeah, precisely. It's the very problem the Get Britain Working Plan is trying to fix, not a scorecard of this government's immediate performance in that first year or so. But opponents sometimes conflate that big, scary structural number with the actual short-term job figures to create a more damaging political narrative. That's why understanding the difference is so important for you, the listener.
Understood. So let's talk about the actual net employment figures during the period the audit covers. If 300,000 is the structural leakage, what do the official ONS stats say about the cyclical job market changes experienced in that first 12-18 months? Was there a contraction?
Yes, there was. The official data from the Office for National Statistics does confirm that the labor market softened during this period. Economists would call it cyclical cooling.
And the key measure, payroll employees.
Yes, the net figure for payrolled employees, arguably the most reliable indicator of job creation or loss, did show a decline between September 2024 and September 2025.
Okay, what was the actual number? How big was the decline?
Over that 12-month period, net payrolled employees fell by 117,000.
117,000.
Yes, which works out as about a 0.4% contraction. Now, that's clearly a significant net loss of jobs and concerning, but it is substantially smaller than that 300,000 structural figure that's often misused. Still, it does represent a definite, measurable tightening of the labor market during that time.
And that tightening, that cooling, that's what led directly to the unemployment rate hitting that 5.0% mark we talked about earlier.
Correct. The two figures go hand in hand. Fewer people on payrolls, more people registering as unemployed.
What was driving that cyclical cooling? Why was the market tightening then?
Well, it's largely seen as the hangover effect from the preceding period of high inflation and the aggressive interest rate hikes used to combat it.
Right, higher borrowing costs.
Exactly. Higher borrowing costs tend to dampen business investment, certainly outside those specific sectors being boosted by the NWF. They also reduce consumer confidence and spending power, so the wider economy was essentially slowing down, throttling back. And these big long-term industrial policies, like building gigafactories, they simply take too long to generate enough new demand to immediately offset that kind of prevailing cyclical downturn.
So, pulling this quantitative assessment together, the core conclusion seems to be that the short-term economic reality, the cyclical cooling, was just completely overpowering the government's ambitious long-term plans in that initial period.
That's a fair summary, yes.
And the danger is that this short-term pain, the rising unemployment, the falling payrolls, actually risks damaging the long-term plan itself.
Absolutely. That's the critical risk here. These negative short-term trends create massive credibility problem. If the public just sees job figures getting worse, and perhaps more importantly, if potential private investors see the UK economy contracting,
They might hesitate to commit that 3x leverage.
exactly. They become less likely to buy into the government's long-term vision, less likely to commit the billions in private capital that the whole NWF strategy depends on. Why invest heavily now if the immediate outlook looks weak?
That credibility risk is huge. Okay, that leads us perfectly into part 5, which feels like the most critical part of the audit. The implementation bottlenecks, identifying the feasibility gap. We've established the plan looks good, structurally sound even, but where is it hitting the buffers in the real world? Where's the execution failing?
Well, the primary failing identified by the audit boils down to what it calls a sequential error.
Sequential error, meaning doing things in the wrong order.
Essentially, yes. The government seems to have prioritized pushing out the capital investment, first getting the money flowing through the NWF. But crucially, they allowed the necessary human capital infrastructure, things like skills training, and also the legislative support for better job quality to lag significantly behind.
So they started building the house before ensuring they had enough builders or that the builders they had wouldn't leave.
That's a pretty good analogy. They focused on creating the demand for labor through industrial policy before fully securing the supply and quality of that labor.
Okay, let's break that down. Let's focus on the skill gap first. The source material calls this the single greatest threat to the whole industrial plan. Just how bad is this gap? How wide is the chasm between the skills needed and the skills available?
It appears to be very wide, severely so. The audit suggests the viability of hitting that 650,000 green jobs target by 2030 is genuinely threatened by this documented acute green skills gap.
Is there data on that?
Yes, there's evidence of a profound mismatch. The demand for green talent within the UK economy, those specific plumbers, electricians, engineers, we mentioned the ones needed for heat pumps, solar panels, insulating homes, working in gigafactories, the demand is currently growing at roughly twice the rate of the supply of newly qualified, skilled, certified workers coming through the system.
Twice the rate. Demand is doubling supply.
Approximately, yes. Demand is massively outstripping the pace at which the training system is producing people with the right qualifications.
So the government pours £7.3 billion into creating demand for potentially hundreds of thousands of specialized jobs. But the pipeline for training the people to fill those jobs is moving at half speed. What happens then? What's the inevitable result of that sequential error?
Well, the consequences are pretty disastrous for the efficiency and cost effectiveness of the whole strategy. Unless there's a massive, rapid acceleration in training capacity, which means more funding for colleges, upgrading equipment, finding enough qualified trainers, streamlining certification, you basically face two bad outcomes.
Outcome one.
The jobs simply remain unfilled. The NWF money gets spent building a factory, but it can't operate at full capacity because they can't find enough skilled staff.
Right.
Or the home insulation program stalls because there aren't enough qualified installers. Investment sits idle, targets are missed.
And outcome two.
Outcome two is that the few skilled workers who are available become incredibly sought after. This leads to rapid, unsustainable wage inflation in those specific trades. Costs spiral upwards, which undermines the productivity gains the investment was supposed to create, and could even discourage further private investment because labor costs become too high. The entire policy gets bottlenecked by the lack of trained people.
A human capital bottleneck.
Yeah.
And is this skills shortage so obvious that others are questioning the government's targets too?
Yes. External analysts are definitely raising red flags. The audit mentions analysis, for example, from groups like the Tony Blair Institute, suggesting that the green manufacturing sector specifically might only employ around 425,000 people by 2050.
2050, not 2030.
Correct. 425,000 by 2050. That's significantly lower and obviously much, much later than the government's headline target of 650,000 plus green jobs by 2030.
Wow. That's potentially a 225,000 job gap compared to one credible external forecast and a 20-year delay. That really suggests the government's target might have a large dose of political optimism baked in, ignoring the practical realities of skills development.
It certainly raises serious questions about the feasibility and timeline, yes. The ambition might be running well ahead of the capacity to deliver.
Okay, that's the skills bottleneck. What are the other major implementation failure identified? The lag in getting the Employment Rights Bill, ERB, fully up and running. This was the part meant to improve job quality and secure the existing workforce.
Yes, the delay in the ERB is highlighted as a major source of policy incoherence, really. The intention that the biggest upgrade to workers' rights is praised as heading in the right direction. But the official timetables, the implementation roadmaps published by the government indicate that many of the core measures in the bill won't actually take full effect until late 2026 or even into 2027.
2026, 2027. That's years after the big industrial funding started flowing through the NWF, isn't it?
Correct.
And it's also years into this ongoing labor market crisis, where 300,000 people are leaving annually due to health issues, often linked to poor work conditions. So delaying the fix just prolongs the problem they claim to be solving.
It absolutely prolongs the conditions of insecurity and potentially poor treatment for millions of workers, particularly those in low-paid sectors. And this delay seems even more problematic when you look closely at the proposed reforms to statutory sick pay, SSP.
Go on. What's the issue with the SSP reform?
Well, the plan includes some welcome changes, like getting rid of the initial waiting days before SSP kicks in and removing the lower earnings limit for eligibility so more people will qualify and qualify sooner.
That sounds positive.
It is, in principle. But the audit points out a glaring omission. There are no immediate plans within the ERB framework to significantly increase the actual level of SSP itself.
So you might get it sooner, but the amount you get is still low.
Extremely low, yes. SSP in the UK is notoriously low compared to average earnings and compared to sick pay systems in many other developed countries. For a worker who has to rely solely on SSP, it represents a massive, often catastrophic drop in income.
So even with the reforms, a low-paid worker getting sick still faces that awful choice. Either drag themselves into work while ill, potentially making things worse or infecting others?
Or stay home and face immediate financial hardship, potentially falling into debt, because the sick pay simply isn't enough to cover basic living costs. By not addressing the level of SFT, the reform only tackles part of the problem.
Okay, so summing up this legislative lag, by pushing the main ERB protections out to 2027, and by not boosting the actual value of sick pay, the government is effectively failing to properly secure the existing workforce now. They're trying to build the extension, new green jobs via NWF, while the foundations of the main house, current workforce health and security, are still crumbling.
That's a very good way of putting it. That inconsistency seriously undermines the whole get Britain working narrative. You can't really have a high ambition industrial plan creating new jobs if you don't have an equally ambitious and, importantly, immediately implemented social plan to protect the workers you already have and make work itself more sustainable. The legislative lag means they're basically allowing that 300,000 a year structural drain to continue unchecked for several more crucial years.
It seems like a major disconnect. Okay, one final implementation bottleneck mentioned is around governance. Specifically, the governance and risk associated with that £7.3 billion National Wealth Fund. It's public money taking big risks. What were the specific concerns raised, for instance, by the Treasury Select Committee?
Well, the Treasury Committee's assessment was quite nuanced. On the one hand, they acknowledged that something like the NWF is necessary. The state does need to act as a risk taker to kickstart these new green markets.
Okay, so they endorsed the principle.
Yes. But they also issued a warning. They specifically questioned whether the current funding envelope, the $7.3 billion, is actually enough to achieve a truly broad, nationwide, regional impact. The risk is it might only be sufficient for a few flagship projects in specific locations, rather than driving the kind of widespread economic renewal that's often promised.
So, potentially not enough firepower for the scale of the ambition.
Potentially, yes. That was the concern. And layered on top of that is the inherent risk that comes with using public money, taxpayer money, and borrowing to finance these potentially high-risk ventures. Scrutiny is guaranteed. Failure will be public.
So what's the key recommendation to manage that risk? How does the government ensure the NWF remains effective and doesn't just become a political football?
Robust, independent governance is absolutely critical. The analysis stresses this. The NWF needs a governance structure that shields its investment decisions as much as possible from short-term political interference.
Why is it so important?
Because it needs the freedom to make commercially sound decisions, even if they involve taking calculated risks. And some of those risks will fail. That's the nature of venture investment. If every decision is subject to immediate political second-guessing or pressure to fund pet projects, it won't be able to operate effectively.
And transparency.
Transparency is paramount, especially around tracking that all-important 3x private leverage target. Is it actually being met? And what's the ultimate return on investment for the taxpayer? If the NWF loses its commercial integrity, if it's seen as just a vehicle for political priorities, then serious private sector partners, the ones needed to provide the 3x leverage, will simply walk away. Its catalytic function would be completely neutralized.
Okay. We have painted a very detailed picture now. A coherent, ambitious vision running headlong into implementation problems, skills gaps, legislative delays, and wider economic headwinds. Let's try and pull all this together in our final section, Part 6, Policy Recommendations and the Forward Outlook. Based on everything the audit found, what's the overall summary? How aligned are the government's intentions and its actions right now?
Well, the summary really captures that tension we started with. You could frame it like this. The government began with very high intentions. The plan itself is clear, it's detailed, it's genuinely long-term in its thinking. Yeah. But the immediate actions, or rather the immediate outcomes, are rated as low. That's evidenced by the facts on the ground during the audit period. Unemployment rising to 5.0%, that net decline of 117,000 in payrolled employees.
So high intentions, low immediate results.
Exactly, which means the overall alignment between the policy ambition and the demonstrable outcomes as of Q3 2025 was judged to be weak. It's being held back by that debilitating policy lag and, crucially, the skills bottleneck we discussed.
Right. If the government genuinely wants to close that gap, if they want to get the plan back on track, I have any chance of hitting those big 2030 targets, what are the absolute top, most critical policy actions recommended by this analysis? What do they need to do now?
They fundamentally need to correct that sequential error we identified, address the lagging supply side immediately.
Okay, so recommendation number 1 must be about the skills crisis.
Absolutely. Recommendation 1 is skills crisis mobilization. The audit essentially says the green skills deficit needs to be treated as a national emergency. This means urgently accelerating funding for training, yes, but also slashing the bureaucracy around it
Wow.
by heavily promoting and funding short-cycle training programs. Things like intensive boot camps that can quickly get people certified in those key shortage trades: electrical work, heat pump plumbing, insulation installation, specific manufacturing skills. We can't afford to wait for traditional multi-year apprenticeships or college courses to slowly adapt. The capital investment through the NWF is happening now. The skills need to catch up immediately.
Treat it like an emergency, fast-track practical training. Got it. What's the second key recommendation? Must be the legislative side.
Yes. Recommendation 2 is accelerated legislative implementation, specifically regarding the Employment Rights Bill. The recommendation is clear. Bring forward the implementation of the core worker protection provisions from the currently planned late 2026-2027 dates, ideally into 2026 at the latest.
Which provisions specifically?
Things like the reforms to zero-hour contracts, strengthening day one rights, ending fire and rehire. And critically, the audit implies they need to include a significant immediate uplift in the actual monetary level of statutory sick pay within that accelerated time frame.
Why is accelerating this so important?
2 reasons. First, it delivers on the social promise made to workers, boosting fairness and security. But second, and perhaps more importantly from a strategic perspective, it proactively tackles those structural factors, insecurity, low sick pay, that are contributing to the 300,000 people leaving the workforce each year due to ill health. You have to secure the workforce you have before you can realistically expand it with hundreds of thousands of new green jobs. Stop the leak before you turn the tap on full.
That makes perfect sense. Fix the foundations first. Okay, those are clear recommendations. But given the trends we saw up to Q3 2025, what's the likely outlook for the UK labor market in the immediate future, say going into 2026? Is it likely to get better quickly?
The immediate outlook described is still pretty challenging. That cyclical cooling effect seems persistent. The audit mentions Bank of England forecasts suggesting unemployment could potentially peak slightly above 5.0% in early 2026 before hopefully starting to come down.
So possibly more short-term pain before any gain.
It seems likely yes, which means that achieving the sustained job creation the government promised, hitting those 650,000 green job targets, hinges absolutely entirely on successfully executing those recommendations, rapidly closing the skills gap, and fully enacting those crucial legislative and health reforms in a timely manner. Success is not guaranteed. It depends on urgent action now.
So the government finds itself walking this incredibly fine line, doesn't it? A credibility tightrope.
Oh, no way.
They've shown they can create a compelling long-term vision that's not in doubt according to this analysis.
Right.
But they seem to be rapidly running out of time to prove they can actually build the necessary foundations for that vision. The skilled workforce, secure working conditions, before either the immediate economic pressures force a change, of course, or before public and investor confidence starts to really ebb away.
Yeah, that's the crux of it. If they fail to decisively speed up these supply-side actions, if skills training and worker protections continue to lag behind the big capital spending, then the probability of actually achieving that 2030 industrial ambition starts to look increasingly questionable. That implementation deficit we talked about becomes a self-inflicted wound that undermines their own strategic clarity.
The strategic vision itself, the audit suggests, is potentially excellent. It's ambitious, it seems comprehensive, it tries to tackle decades of structural weakness in the UK economy head-on.
Yes, the what is broadly sound.
But this deep dive provides a really sobering reality check. Execution failures, that critical sequential error, and this massive implementation lag mean the strategy was, at least initially, failing to deliver on its promises and struggling against the economic tide.
It really comes down to a test of state capacity, doesn't it? Can the machinery of government actually move as fast and effectively as the capital it's trying to deploy?
And that brings us to a final crucial question for you, the listener, to think about after this deep dive. We've heard that the entire success of the National Wealth Fund, and by extension a large part of the Jobs Plan, rests on its ability to leverage 3 times its own investment from the private sector. That leverage depends entirely on future confidence in the UK market.
Confidence is key.
So the question is, how does the current negative short-term trend we've discussed, the reality of rising unemployment hitting 5.0%, falling net payroll numbers, how does that immediate reality impact the government's credibility in the eyes of those crucial private investors they need to bring on board? If the economy looks weak now, will those investors really bet £3 for every £1 of public money on a promise of jobs and growth potentially years down the line in 2030?
That confidence gap. Bridging that gap between the short-term pain and the long-term promise. That's surely the central political and economic challenge facing the government in the coming years.
Indeed. Well, that's all we have time for on his deep dive into the source material surrounding UK job creation policy. Thank you for joining us.
Thanks for listening.
We'll be back soon with more critical insights extracted directly from the source.